Welcome to InstaOwl's classes. We at InstaOwl believe in democratizing education for one and for all. Welcome students, you're going to start studying how the money concept originated and what it links us to the economy of this country. Let's start money and credit. Understanding the evolution of money. History and evolution. Money has a rich history with various forms used over time. Modern forms of money are linked to the banking system, which you will see in detail in this chapter. We also have a concept which was recently introduced in November 2016, in which we stopped using the notes of rupees 500 and 1000. That is called as demonetization. Rupees 500 and 1000 notes were declared invalid in November 2016. Emphasis on digital transactions over cash to reduce corruption. We also will see what are digital transactions. The growth in the use of internet banking, mobile transfers, checks, ATM cards, and POS means point of sale machines. Students can explore the impact and legitimacy of cash versus digital transaction. This also we will study in this chapter. We have to understand the term, what is the meaning of credit? And credit is vital in economic life, particularly in ensuring access for the poor. It emphasizes the need for fair and reasonable credit terms as a right for all. We're also going to start studying the importance of credit and what are the challenges in financial inclusion. Importance of providing credit to all, especially in developing countries. Encourages awareness of innovative solutions like the NABARD Bank while acknowledging the need for new approaches. Money for exchange. Existence of money in daily life. Money is central to many daily activities. Transactions involving goods often use money for exchange. Now, students, you all are going to start studying the meaning of what money and credit is. But please understand that in the history, there was no form of money used. Today, we have notes. You have all seen notes in your houses. You've seen coins in your houses. But in the older times, we had a system known as the barter system, which you're going to study. The barter system was an exchange system in which I would give you 1 kg of rice because my field would produce rice, and if your field produced wheat, you would give me 1 kg of wheat. Or if somebody would produce potatoes on their land or tomatoes on their land or onions, they would give that in exchange for something that they would get. This kind of exchange was called as the barter system. We're talking about money over here. Money came much later. After coming of the ancient kingdoms, we started with metallic coins. Coins that were made out of silver, gold, copper, bronze. Such coins were made for exchange of money. But what happened in the later stages is when the kings also left us and we started getting a proper formal government, they started making money. How do you make money? They started printing money. And printing money in economics is called as mints. We have mints. These are called as mints. Mints are big, huge factories which have a license given only by the Reserve Bank of India, which allows them to print notes. Now, when we use notes in the legal tender in the market means to buy something. If I want to go to the shop and if I want to get one piece of chocolate, I will have to pay some amount of money. Money is a central activity in most of our daily chores. Transactions involve goods often use money for exchange. Today, the only kind of tender or legal exchange is money. Services are also commonly exchanged for money. Services like teaching services, banking services, and some transactions involve a promise to pay later rather than immediate payment. Importance of money in transactions. Understanding everyday transactions involving money. Money simplifies transactions by allowing easy exchange for goods and services. Without money, direct exchanges require a double coincidence of wants. Means what? Without any money, if you want something like 1 kg of wheat, you also want 1 kg of potatoes, 1 kg of tomatoes, or you want half a kg of potato, half a kg of tomatoes. Exact value is not got when there is no money. In a barter system, both parties must want what the other offers, making transactions more difficult. eliminating the double coincidence of wants. Money eliminates the need for double coincidence of wants. It simplifies trade by allowing transactions without specific barter requirements. What I'm trying to tell you is that double coincidence means in money, you get exact value. You get exact value means for rupees 5, I can get a small chocolate. But for rupees 5, I cannot get a very big chocolate. Why? Because the value of my money is only rupees 5. It is only rupees 5. That makes it very easier to have one want and have one value of money. This simplifies trade by allowing transactions without specific barter requirements. Money enables purchasing any commodity after selling goods or services. It acts as an intermediary, hence money is also called a medium of exchange. In economics, a medium of exchange means your legal tender or money. From barter to coins, let's see. Money functions as a medium of exchange. Early forms of money included grains and cattle. Metallic coins were also used like gold, silver, copper. The use of coins persisted well into the last century. Let's see the evolution of money in exchange. What is the role of the government? Now, it authorizes currency. Modern money includes paper notes and coins. Now, which paper? It's not the normal paper that you use. It is a special kind of paper which is manufactured only by the government. They use these notes and coins. Unlike earlier money forms, modern currency has no intrinsic value. Means it has no actual value in itself. What does intrinsic means? The quality of being essential, the inherent value or characteristic of an object or a coin. Like first, I'll tell you an example. We used to get gold coins. So the gold coin itself was very expensive, even if it was only for 10 rupees or 20 rupees or 10 paisa or 20 paisa. Like that, today's money is just a paper note which has some kind of amount printed on it. The value comes from the government. The value comes from the government. That is why it is called as legal tender. Money is also called as legal tender. Unlike earlier money forms, modern currency has no intrinsic value. The value to the money today is given by the government by making it legal tender. That is why in the process of demonetization, it was very easy for the government to say that the rupees 500 note and the rupees 1000 note was no longer a legal tender. Means what? They just took away the value of rupees 500 and rupees 1000 in the process of demonetization. Accepted as a medium of exchange due to government authorization. In India, the Reserve Bank of India issues currency note. Please understand the only authority to issue notes in India is the RBI. The RBI is the head of the banking system and the only authorizer for issuance of notes. Indian law ensures that the rupee is the only legal medium of exchange which must be accepted in transactions. Money as bank deposits. Now let's see. We're going to start studying what kind of other mediums of exchange or transactions we are going to see in this chapter. First you have seen is money, that is paper notes or legal tender. A bank is a system, an institute which takes care of the money, which handles the money rolling in the society or rolling in the economy. We are going to understand demand deposits and check payments. What are these two things? People also hold money as bank deposits. So now remember, why is it called deposit? Deposit means to give something to somebody. I deposit my jewelry with my friend. I deposit my money with my mother. Like that, you deposit your money in the banks. That is why it is called as deposits. The first word that you can see over here is called demand. Why is it called demand? Because it is the right of the customer to demand his money. I can approach the bank anytime I want and I can demand for my money to be given back to me. Such money put into deposits which can be withdrawn at any time is called a demand deposit. Let's see. People also hold money as bank deposits. Surplus cash is deposited in the bank account for safekeeping and interest. Yes. So when you keep your money in banks, children, there is a small amount of interest that you get. Why? Because the bank is using your money. So they pay you an extra amount. That extra amount is called as interest. Please look here. Deposits can be withdrawn on demand anytime by the customer. Hence, they are called as demand deposits. Demand deposits serve as a medium of exchange through check payments. Checks instruct banks to pay a specified amount to the person named on the check. So you've been introduced to another form of transaction that is called demand deposits, and the third part is called check payments. You must have seen your parents writing a check to your school or to your teachers or to your sports activities. You're going to see the picture of a check in the later slides. Cashless transactions through checks. Mr. Salim is a shoe manufacturer. He pays his leather supplier using a check. The check instructs Salim's bank to transfer the specified amount to the supplier's bank account. The supplier deposits the check and the money is transferred between accounts within a few days. The transaction is completed without using any cash. So this process is how the transaction takes place without cash. Please look at the screen. This is a specimen of a check. Over here, to pay is always to the person that I want to pay, the person who I have to give money to. That person's name will come over here. The amount will come over here. How much amount do I want to give? That is going to be in words. That is going to be in words. And the amount that I want to pay in numbers. Suppose I want to pay somebody 10,000 rupees. This is the amount. The date will go here. The bank name will go here. The check number is here. This is the series. This is the series of the bank's checks. And this will be your signature. This will be your signature. So the bank will understand that this check has come from Mr. X, if I am Mr. X, and I'm paying to Mr. Y. So Mr. X gives this signature check to his bank, and the bank pays this amount to Mr. Y in 2 to 3 business working days. Demand deposits, we're going to see another part. Banking facilities and cashless payments. Demand deposits function as money by enabling payments via checks without cash. These deposits, along with currency, are widely accepted as money in the modern economy. Banks are essential for the existence of demand deposits and check payments. Modern money, including currency and deposits, is closely tied to the banking system. So you've been introduced to the institution known as bank. You have also seen what are demand deposits and how do we do them. We also do cashless transactions with the help of check payments. Now, let's see the function of banks. So banks are financial institutions where people go to keep their money or get a loan from, and they also get an interest. Bank and loan activities. Banks keep a small percentage, almost 15% of deposits as cash reserves. Yes, the bank has to always keep a cash reserve with them. As suppose you are keeping some kind of money in the bank in total will see the money that is kept with it, and with 15% of the total money in the bank has to be kept in cash, always. The rest of the deposits are used to provide loans. So now what do the banks do? The money that is kept with them, let's give you an example of rupees 100. Rupees 100 is the deposit with the bank. 15% goes in cash. 15 rupees are always in reserve money. This is reserve money, reserve cash. Correct? But 85 rupees will go in the form of loans. So now what is the bank going to do? Suppose a needy person comes to the bank, a person who really needs the money, they need it for their car, they need it for a home loan, need it for education loan. They are going to give money out of this 85 rupees. The banks will give loans from the 85 rupees. They will never touch the reserve cash of 15 rupees. This is just for example purposes. Banks act as an intermediary between depositors with surplus funds and borrowers who are in need of funds. The primary source of income for banks is the difference between the interest charged on loans and the interest paid on deposits. So like I told you, when you keep your surplus money in the bank, they give you a small amount of interest. That is called the interest that they give you. But when they give this 85 rupees as loans, they charge a higher amount of interest. on this 85 rupees. The difference of these two interests is the earning money for the bank. This is a picture illustration of how you have just learned the bank's work. Please look at this side. These are depositors who have extra money, who have extra surplus money. They put it in the bank. They put it in the bank called as demand deposits. Now these deposits, when they put in the bank is going to give them some kind of interest when they remove their money. So the bank also gives them a small amount of interest. This happens with the depositors who have extra money. Please look at this side. These are borrowers. These are people who need the money for some kind of commodity, a car, a house, some education loans. So what do? They go to the bank, they ask for money, they take the loan, and when they repay their loan, when they give it back to the bank, they repay it with interest. So the difference that you can see is that borrowers have to repay loan with interest. They have to give out more money to the bank. And depositors who give money to the bank, they get more money from the bank due to interest. The difference between what the banks are earning, giving them and taking from them, right? The difference is what the bank earns. So let's give you an example. Suppose the bank is taking money, 200 rupees extra as interest from the borrowers. But when she is giving only 100 rupees as interest to the depositor. Let's see the difference of 100 and 200. The bank earns 100 rupees as her money. Means this is her earning. Two distinct credit scenarios. Let's understand the meaning of credit. Credit means loan. Another word for credit is loan. What is the role of credit in daily transactions? Credit is commonly used in various day-to-day transactions. Credit involves an agreement. It's an agreement where the lender who is giving the money, provides resources to the borrower with a promise that if I'm giving you money, you will pay back my money in the future. So it's a promise of future repayment. The concept of credit can be understood better through practical examples. In InstaBytes, we're going to see a case study of Salim, credit utilization in business operations. Salim receives a large shoe order for the festival season. He hires extra workers and needs more raw material, leading him to seek credit. Now, because of the festival season, his workload has increased. Now the workload has increased, so he needs a lot of supply of raw material. Now if he needs that, he wants to purchase it with money. So he's going to take credit. Let's see from whom. He secures loans by promising future payment to the leather supplier. So he tells him that I'm taking a loan and I will pay back the loan in the future. He obtains an advance from the trader. Now there is another trader who gives him an advance. He completes the order, makes a profit, and then repays the loan successfully. Let's explain it to you. What happens in Salim's case? He takes loan, he makes the order, he sells the order, makes the profit, gives it back to the person who gave him the loan. This is the business transaction that you have seen in 3 steps. Yes, and this is one example in how credit can be used. How credit supports working capital needs. Working capital, please understand what's the meaning of working capital. Working capital means money needed to run the business. Salim is running a business of shoe manufacturing. The money that he needs every day in one business day is called the working capital. So how does loan or how does credit support your business's working capital needs? Salim uses credit to address working capital needed for production. Credit enables him to manage ongoing expenses and complete the production on time. As a result, his earnings increase, highlighting the positive role of credit in this context. So there has been a positive use of the loan that he has taken. He has increased his earnings and then paid back his loan. Credit helps Salim meet production costs and complete orders on time. His earnings increase, demonstrating a positive outcome of credit. Now, we are going to see another case study of Swapna. Let's see. Swapna's case study, she takes a loan for cultivation, but her crop fails due to pests. Now, we are introducing ourselves to another case study in which Swapna is a farmer and she is borrowing some kind of loan so that she can cultivate her crop. So she takes a loan for cultivation, but what happens? Her crop fails. Why? Because when the crop is growing, it is attacked by pests. Pests are small animals which eat the crop. So her crop fails. Now she cannot go to the market to sell her crop because there is no crop. If she cannot sell her crop, where is she going to earn her income from? If there is no income, she is already failed. As a crop has failed, her income has failed. Unable to repay, her debt grows. Now she has no money to repay her loan. What is she unable to? Her loan she cannot repay. So what happens is her debt grows. Debt means another word for loan. When you are in debt, you are in loan. You are a liability. You have to pay back that money. So how does her debt grow? Because she has no money to repay what money she has taken for cultivation, she is now again going to borrow money so that she can pay the first loan. Then she will take money the third time to pay off the second loan. She'll take money a fourth time to pay off the third loan. This is the meaning of increasing debt. She takes another loan. So unable to repay her loan, her debt grows and she takes another loan. Despite a normal crop, the next year, she still remains trapped in debt. So next year, she will have a normal crop. She will earn her money. But she's already taken so many loans that the money that she earns is all going away only in repaying loans. Ultimately forced to sell part of her land to pay off the debt. So it's a very sad story, a negative impact of loan that we can see, that she was forced to sell her land to get the money to pay off all the debt. Let's see the credit outcomes in the conclusion. Credit can have both positive and negative effects depending on the circumstances. Salim's case shows how credit can support growth, while Sapna's situation highlights the risks and challenges that can lead to a debt trap. So what we have seen in Swapna's case, where she takes one loan, the crop fails, she takes the second loan to repay the first loan, she takes another loan to repay the second loan, and even if the next year her crop is good, she already has earned very less amount compared to her repayment. So whatever she earns, she gives it back to the debt. That means to repay her loan. In such situations, you can see that the farmers never get out of that trap, that never-ending cycle of poverty. Such kind of risks and challenges can lead to something called as a debt trap. Credit in crop production. Let's see. Financial needs of rural farmers. Crop production is the main reason for credit demand in rural areas. In rural areas, villages, we are still an agrarian economy. India today also has a lot of agricultural land and we are an agrarian economy. In this economy, the most amount of money that is borrowed in the villages, in the rural areas, is only for crop production. Like farming, farming involves substantial costs for various inputs like seeds, fertilizers and equipment. There is a 3 to 4 month gap between purchasing inputs and selling the crop. Farmers take loans at the beginning of the season and repay them after harvest. So after harvest, when they get the produce, they sell it in the market, then they repay their loan. Loan repayment is heavily dependent on the success of the farming income. So in this situation, in the rural farmer, we can see that the farming is not in our hands because it depends on natural factors such as air, such as wind, such as rain. Crop failure prevented Swapna from repaying her loan. She was forced to sell part of her land to clear the debt. Instead of improving her finances, credit worsened her situation. This is an example of a debt trap where credit leads to severe financial difficulties. So, if your credit is leading you to severe financial difficulties over and over again, this situation is called a debt trap. When credit helps and when it hurts. Credit can either improve or worsen financial situations. Success leads to higher earnings, making the borrower better off. Failure, like a crop failure, can lead to a debt trap and financial loss. So over here it helps, over here it hurts. The usefulness of credit depends on the risks and available support in case of failure. Let's see what we have studied in this chapter. We have seen modern type of money, that is legal tender, paper notes and coins today. We have also seen the institutions of banks. Banks are the major financial institutions in this country in which depositors go to deposit the extra money and borrowers go to take loan from the bank. We have also seen the two types of credit in rural areas. In rural areas, if the crop fails and the farmer cannot give back the credit, cannot repay the loan, he is forced to take another loan or he or she is forced to sell a part of his land. This is called as a debt trap or the negative effects of credit. But you have also seen the positive effects of credit, where Salim in his business could use the credit to become a successful more business person. I hope you have understood the part of money and credit. Please keep watching InstaOwl's video for the next part on the same chapter. Thank you.